Disclaimer.
Friday afternoon. Most silver holders did what they always do. They checked the price, saw green, closed the app, and headed into the weekend feeling pretty good about where things stood. And honestly, you can't blame them. Green is green. Up is up. That's the game, right? Except today was not a normal Friday. Today was March first notice day on the COMEX. And if you don't know why that matters, that's exactly the gap this is going to close for you right now. First notice day is the single most critical deadline on the COMEX calendar. It's the cutoff by which anyone holding a futures contract has to declare their intentions. Do you want actual physical silver delivered to you, or are you rolling your paper position forward into the next month? For decades, this day has followed a completely predictable pattern. The paper players win, the big institutions roll their positions forward, longs back off, delivery numbers stay manageable, and the COMEX vault breathes easy for another month. That has been the rhythm of this system for years. Today, that rhythm broke. Here's what should grab your attention. The price went up on first notice day, and in any other market context, you'd celebrate that. But if you understand what this day actually measures, a rising price on first notice day is not a celebration signal. It's a tell. It means the buyers who showed up today were not trading. They were taking. They weren't rolling forward. They were standing firm and demanding the real thing. When paper is supposed to win and doesn't, the price moving up is the market's way of saying the math underneath just changed. So let's talk about the number, because the number is what changes everything. 52.63 million ounces stood for physical delivery today. Not paper, not certificates, not rolled forward promises that get recycled through the system month after month. Actual metal, claimed, committed, and being pulled from the COMEX warehouse system. Take a moment with that figure before we go any further, because the raw number alone doesn't tell the whole story. It's what that number lands against that makes this a different conversation entirely. The COMEX system has what's called registered silver, inventory that is legally committed and available for delivery against futures contracts. Think of it as the vault's active deliverable stock. Everything else sitting in COMEX warehouses is eligible. It's there physically, but it's not on the table for delivery unless the owner explicitly moves it into registered status. Today, the registered silver in the COMEX system stood at 86.13 million ounces. That's the legal universe of silver that existed to cover delivery obligations. And 52.63 million ounces just claimed against it. Do that math with me. 52.63 million ounces claimed against 86.13 million registered. That's a 61% claim rate against the entire deliverable inventory in a single session. More than half the COMEX's deliverable silver got absorbed in one day. The vault that opens March with its entire system designed around managing these deliveries in an orderly fashion now enters the month with its back genuinely against the wall. Think about what it would mean if 61% of anything you depend on got committed away on a single Friday afternoon. Your retirement account, your emergency fund, your home equity. Now imagine that system has to keep functioning normally for the next 30 trading days as if nothing happened. That's the position the COMEX just walked into. And most of the people watching silver prices this afternoon saw a green candle and called it a day. But here's where the story gets bigger than COMEX. Because if this were only a COMEX inventory story, you could argue it's a plumbing issue. Internal, technical, manageable. What makes today genuinely different is what was already happening on the other side of the planet before this number even printed. Shanghai silver inventories hit their lowest level since 2015 this same week. Not a slight dip, not a temporary drawdown that bounced back. The lowest reportable level in over a decade in the world's largest physical silver market. When you see the world's biggest physical silver exchange and America's primary futures delivery system both showing acute shortage signals in the same 7-day window, you are no longer looking at a COMEX technical story. You're looking at a global physical story that happened to become visible on your screen today. And then there's PSLV, the Sprott Physical Silver Trust, one of the most transparent ways American retail investors can hold physical silver in an allocated, audited structure. This week, the premium on retail silver coins relative to PSLV's spot price blew out to 23.6%. Meaning if you tried to buy a silver coin at your local dealer and then compare what you paid against PSLV's quoted value per ounce, you paid $149 for something priced at $83.73. That's not a small retail markup. That's the physical market telling you something that the paper price is not yet fully reflecting. 3 signals, same week. 3 different markets. Chicago, Shanghai, and retail coin dealers across our country, all screaming the same thing in 3 different languages. The physical silver that underpins every paper contract, every ETF share, every futures position is getting harder to find and more expensive to touch. The green candle on your app this afternoon was not the signal most people thought it was. Most people closed their apps feeling fine. They saw the right color and drew the wrong conclusion. What actually happened today was that the buyers who understood this system, who had been watching the warehouse reports month after month, who knew exactly what first notice day meant, those buyers showed up and did not flinch. They took delivery. All 52.63 million ounces of it. And now the COMEX vault enters March with a claim rate that has never been designed to be this high, in a global physical market that has never been this tight, against a backdrop that most weekend silver watchers will spend Saturday completely unaware of. You now know what the green candle actually meant. The question is, was today a spike, or was this inevitable? Because if you trace the evidence back far enough, the answer to that question changes everything about how you read what comes next. January 2024, February 2024, March 2024. Every single month, more silver left the COMEX than the month before. The CME warehouse reports were public. The data was sitting there, available to anyone who wanted to look. But nobody wrote the headline. Nobody connected the dots in real time, because each individual month looked like noise. One data point doesn't make a pattern. Two don't either. But 12 in a row? That's a story hiding in plain sight, and it took until today for most people to finally see it. Let's walk this back like detectives, because that's exactly what it requires. The year 2024 closed with 203 million ounces delivered through the COMEX system. That number alone sounded large. But then 2025 happened. Every single month of 2025 beat the same month in 2024. Not once, not twice. Every single month without exception. By the time 2025 closed, total COMEX silver deliveries had hit 474 million ounces. That's not a spike. That's not a short squeeze. That is a 2-year structural shift, a systematic month-by-month decision by large players to stop rolling paper and start taking metal. And the mainstream financial narrative almost completely missed it. Think about what that kind of shift actually looks like from the inside. Picture a warehouse. Not an abstract vault, but a real facility where actual silver bars sit on shelves, tagged, tracked, and committed to specific owners. Every month through 2025, more bars were walking out the door than the month before. The people running that system could see it happening. The CME published the numbers. But because the market price didn't scream about it, because silver wasn't making front-page headlines, the slow bleed went unnoticed by the people who needed to notice it most. Everyday American investors who hold silver in their portfolios and deserve to understand what was building beneath the surface. Now, let's look at what happened when 2026 opened, because this is where the acceleration becomes impossible to ignore. January is historically one of the quietest months on the COMEX delivery calendar. Low volume, thin participation, institutions resting after year-end positioning. So when January 2025 delivered around 6.8 million ounces, that fit the seasonal pattern perfectly. Quiet month, quiet delivery number, normal. But January 2026 delivered 49.4 million ounces. That's 7.27 times what January 2024 delivered. In a month, that historically idles. And the only way you get a number like that in a historically minor month is if large institutions were front-running what they already knew was coming. A vault that was shrinking fast, and a March 1st notice day that was going to be unlike anything the system had recently absorbed. They were right to front-run it. Today confirmed that entirely. Here's the cumulative math that makes your stomach drop when you lay it out. January and February 2026 alone removed 74.4 million ounces from the COMEX registered silver inventory. And today's 52.63 million ounce delivery claim landed against a registered pool of 86.13 million ounces, which means in roughly 60 days, institutions claimed an amount equal to 86.4% of today's entire deliverable inventory. The vault didn't empty overnight. It emptied slowly, then fast, exactly the way Ernest Hemingway once described going bankrupt, gradually and then suddenly. So where does PSLV fit into all of this? Because this is where the story becomes directly actionable for you. The Sprott Physical Silver Trust currently holds 217.6 million ounces of fully allocated, audited physical silver stored at the Royal Canadian Mint in Canada. Every ounce is accounted for, independently verified, and backing your position dollar for dollar. While COMEX registered vaults have been draining month after month, PSLV's holdings have been growing. That structural contrast matters, because it tells you which direction the smart institutional money has been moving physical silver and what kind of vehicle they've chosen to accumulate it in. Right now, PSLV trades at a 3 to 4% discount to its net asset value. What that means in plain terms is this. You can buy a share of PSLV today and get physical silver for less than the audited value of the actual metal backing that share. You are buying real silver at a discount to the price of real silver. On its face, that sounds like an obvious opportunity. But history gives it even more weight, because this exact setup, a modest discount to NAV, has appeared before at a very specific point in the PSLV cycle. In 2021, PSLV's discount collapsed toward premium before spot silver moved. Retail demand surged, institutional visibility arrived, and by the time most investors realized what was happening, the discount window had already closed. Today's setup is structurally similar, except it's happening against a physical inventory backdrop that is meaningfully tighter than 2021. The COMEX had more registered silver then. Shanghai inventories weren't at decade lows. Lease rates weren't at 8%. The 2021 episode had energy. This one has the same energy in a smaller room. Speaking of lease rates, let's talk about that number for a moment because it might be the single most underreported signal in this entire story. Silver lease rates hit 8% annualized by January 2026. The historical normal for silver lease rates sits between 0.3% and 0.5%. When a large institution needs to borrow physical silver overnight, not paper exposure, not a synthetic position, but actual metal, they typically pay a fraction of a percent for the privilege. The fact that institutions were willing to pay 8% annualized just to get their hands on physical silver for short-term use tells you everything about how difficult that metal had become to source. The lease rate is the market's internal stress indicator, and by January it was running at roughly 20 times its historical baseline. That number didn't make headlines, but it was the market whispering very clearly what the spot price had not yet fully said. And then there's the geopolitical layer, because silver doesn't move in a vacuum, and the world around it this week was anything but quiet. The USS Gerald R. Ford carrier strike group has already been repositioned near Israel. CENTCOM briefed senior officials on Iran strike contingencies. Iranian state television reported that Tehran rejected proposals to transfer enriched uranium abroad. The same week that Geneva nuclear talks were described by participants as the most intense session so far. Every one of those headlines carries a geopolitical risk premium that flows directly into precious metals. Silver doesn't just respond to inventory math, it responds to the world feeling uncertain, and the world this week felt very uncertain. What's important to understand is that geopolitical pressure doesn't disappear between diplomatic sessions, it rests. The premium is still in the market. It's sitting there coiled, waiting for the next headline to either release pressure or amplify it. And Monday, the next headline arrives. So step back and look at what we've actually traced here. 2 years of accelerating physical demand that the mainstream narrative completely missed. A January 2026 delivery number that should have been a flashing warning signal. A cumulative drain that removed 86% of today's registered inventory in just 60 days. Lease rates screaming 20 times their historical norm. Shanghai inventories at decade lows. Retail coin premiums at 23.6% above spot. And today, first notice day. The day paper was supposed to win. The buyers showed up and took 52.63 million ounces of actual metal anyway. None of this happened suddenly. Every piece of it was building month by month in reports that were publicly available and largely ignored. The pattern was always there. It just took today to make it undeniable. You now know the breadcrumbs that led here. The only question left is what you do with that knowledge before Monday's open. Here's the thing about this weekend, and this is important to get right from the start. You are not supposed to react to spot price moves between now and Monday morning. Weekend silver trading is thin, illiquid, and largely unrepresentative of what institutional money is actually thinking. The Asian session will tick, prices will move, and almost none of it will tell you anything meaningful about the real direction of this market. If you chase weekend spot price action, you are reading the wrong signal entirely. What you should be doing this weekend is positioning your attention correctly on two very specific data points, because those two signals, and only those two, will tell you more about where this goes than any overnight price movement in a session where the real players aren't even in their seats yet. You now know something most PSLV holders going into this weekend simply do not. The question is how to use it. Signal 1 lands Monday, and it's coming out of Vienna. The International Atomic Energy Agency begins technical talks Monday on the Iran nuclear framework. And before you wonder what a diplomatic meeting in Austria has to do with your silver position, let's trace that connection clearly, because it's direct and it matters. Walk through the first scenario with me. If Monday's Vienna session produces meaningful framework progress, language that suggests Iran and the West are moving toward a verifiable agreement on enriched uranium, geopolitical pressure on silver partially releases. Money that moved into precious metals as a risk hedge begins rotating back toward risk assets. You could see silver pull back in the short term, and PSLV's price would move with it. For a PSLV holder in a tax-sheltered account, an IRA, a retirement account where you're not generating taxable events on short-term moves, that kind of dip is actually a secondary entry opportunity, not a reason to panic. The physical inventory math underneath does not change by a single ounce because diplomats shook hands in Vienna. The structural story remains completely intact. You'd simply be buying more of the same thesis at a slightly lower price. Now walk through the second scenario. Vienna breaks down, talks collapse, no framework language emerges, or worse, Iran makes a statement that hardens the standoff. In that environment, silver spikes sharply on geopolitical risk premium. But here's the nuance most people miss. Sharp geopolitical spikes in silver are often followed by risk-off pressure, where investors sell everything, including metals, to raise cash and reduce exposure. If you're in a taxable account and a spike puts you in short-term gain territory, you need to think about that tax consequence before the headline hits, not after. The decision you make in a calm weekend moment is worth more than the one you make in a reactive Monday morning spike. These two Vienna outcomes are not equal for a PSLV holder, and your account type determines which one creates opportunity and which one creates a trap. Signal 2 develops over the next 5 to 7 trading days, and it lives in May open interest. This one requires a little patience, but it may be the most important signal of the two. Here's why. The 52.63 million ounces that stood for delivery today had to come from somewhere. From large players who made a deliberate decision to take physical metal rather than roll their contracts forward. Now the question is, what do those same players do next? Do they cash settle, take their metal, and step back? Or do they roll their capital straight into May futures, signaling that today was not a one-time event, but the opening move of a sustained spring delivery campaign? Watch the May 2026 open interest over the next 5 to 7 trading days. If large new May positions appear, if the open interest in May silver builds meaningfully rather than fading after today's action, that tells you something precise and critical. Today was not a spike, it was a strategy. The same institutions that just claimed 52 million ounces in March are setting up to do it again in May. And if that happens, the cumulative math of Q1 2026 reaches approximately 124 million ounces, drained from a system that entered the quarter with only 167.7 million registered. Think about that ratio for a moment, a single quarter absorbing nearly 74% of the vault's opening registered inventory, in a system that was never designed to sustain that pace. That single data point, the May open interest trend over the next week, tells you whether today was a moment or the beginning of a movement. It's the difference between a headline and a structural shift. Now let's talk about the PSLV entry window specifically, because the discount matters more than most people realize. PSLV currently trades at a 3 to 4% discount to its net asset value. That gap between what you pay for a share and what the audited physical silver backing that share is actually worth is your structural entry advantage. You're not speculating on a price prediction when you buy PSLV at a discount to NAV. You're simply acquiring physical silver at below its independently verified value. That's the mechanical reality of where the trust sits right now. But history adds a layer that makes this more urgent. In 2021, that discount window closed faster than most retail investors expected. Institutional visibility arrived, demand for allocated physical silver spiked, and by the time the broader market caught up to what was happening, the discount had already evaporated. The investors who were positioned before that visibility arrived captured the full move. The ones who waited for confirmation caught the tail. Today's setup carries the same structural signature, but against a physical backdrop that is materially tighter than anything 2021 presented. Less registered silver, higher lease rates, lower global inventory. The compressed fuel is the same. The room it's burning in is smaller. This is not a price prediction. It is a structural observation about where you sit in the cycle relative to where the discount has historically been right before it closes. So let's close the loop, because we started this together on a Friday afternoon, and that's exactly where we need to land. Most people checked their silver position today, saw a green candle, and felt reassured. They did what rational investors do with positive price signals. They relaxed. They went into the weekend feeling fine. And in most market contexts, that's the right response. Green is good, up is up. But today was first notice day. And on first notice day, the green candle was not the signal it appeared to be. It was the tell. The day paper was historically supposed to win, the day longs were supposed to roll forward and let the system breathe, and instead 52.63 million ounces of physical silver got pulled from a vault that only had 86.13 million ounces available to cover it. The buyers who showed up today were not traders managing exposure. They were people who wanted the metal, understood what the vault looked like, and decided this was the moment to take it. Your weekend job is not complicated. It is actually very simple. Watch two numbers. Watch PSLV's NAV discount. If it begins compressing towards zero, if the gap between what you pay and what the physical metal is worth starts closing, that is institutional money arriving. That is the 2021 pattern initiating again in a tighter market. And watch Vienna Monday, because that single diplomatic headline will set the short-term tone for precious metals before American institutional desks are even fully staffed for the week. Those two signals, the discount in Vienna, will tell you more about where this goes than anything that happens to spot price between now and Monday morning. The thin overnight markets will move. Ignore them. The real story will show up in those two numbers. Most people went into this weekend seeing green and feeling fine. You went into this weekend knowing what the green actually meant. That gap between what most people see and what the evidence actually shows is where every meaningful financial decision begins. Watch the two signals. Know your account type before the Vienna headline drops. And understand that the vault that just absorbed 52 million ounces in a single session enters March with less room than it's had in years, in a global physical market that is tighter than it's been in a decade. The information is yours. Now it's just a matter of what you do with it.